All right, what's up, everyone? So today I'm going to do a Chipotle DCF built from scratch. And if you voted a few days ago, I actually issued a poll on YouTube asking people if they wanted to see Spotify or Chipotle. And Spotify actually won by a few percentage points, but I thought it was so close that it'd probably be better to do Chipotle because after looking at Spotify's numbers, the company is barely profitable. And so doing a DCF on the company would be a little bit tricky and a lot of guesswork compared to Chipotle, which I looked into and is very, very profitable. And really quickly, I wanted to go through the agenda. So, by the way, I had some issues with my mic. So, let me know in the comments or chat if it's a little bit too low. But for this stream, you may have to increase your volume quite a bit. And hopefully in future streams, I can fix it. But if it is an issue, but right now, this is kind of the best I could do. Anyway, so into the agenda, we're going to first go into a situation overview for the company, then go into trading comps, street-based DCF, then something we haven't done before is calculate the diluted share count ourselves, then go into WACC mid-year convention, build one or two sensitivity tables, and then a brief price discussion. So starting off with the situation overview, the bull case, a lot of digital sales growth via its apps and ride delivery. And so this is something that's really pushing revenue forward these days for the company. I personally have used Chipotle app a few times, and it actually is pretty nice because you could do a lot of customizations. And also, funny enough, after I finished this stream, I actually ordered Chipotle because I thought it was really fitting. Second part of the bull case, domestic and international expansion opportunities. Now that the brand is really well established, it could really expand to a lot of different places. And I personally remember when I used to travel, I would always think back, like, man, I can't wait to come back home and eat some Chipotle. One time this was back in college, a long time ago. I was climbing Mount Kilimanjaro and I was so hungry. And then I dreamt that I had Chipotle and I woke up and I was like, damn it. Like, I wish I was in the States right now. Anyway, next, customer loyalty due to high quality fresh ingredients. I think Chipotle is one of those stores that you just kind of go back to over and over again. So very, very sticky product kind of. With that said, bear case, rising labor and food costs can pressure margins. And I think we're seeing with inflation, a lot of food costs rising and Chipotle also getting a lot more expensive. So I remember when Chipotle first came out, a burrito would be like $6 or something like that. And now it's like at least 12 to 14. Tough competitive landscape in fast casual dining sector. Food is just a really tough industry. And last but not least, susceptible to black swan events like disruptions to supply chains, aka COVID, economic downturns like in 2008 and 2020, and food safety issues with which Chipotle has had in the past. So let's go into some notes really quickly. So this model will be available for free to download after this stream ends. You can see the description. This is also a high-level street-based DCF and not financial advice. I actually also also created a Discord for people to, a lot of it, a big reason was actually because a lot of times people in the chats for these streams would kind of like talk to each other, answer questions and stuff like that. So I was like, oh, well, seems like a lot of people could just like establish relationships here. And I wanted to actually post the streaming is happening now. Yeah, so it's really small right now because just getting started. I think there's like maybe like 75 to 100 people in here. But feel free to join, and we have some like community. It's very new, but I think like over time we'll kind of build a lot of this out for like career advice or people just chatting with one another. We'll have like community chats and whatever, and you can also make some requests in here as well. So someone asked for an asset management channel, and so I made that the other day. That's the Discord. I'm also working on a how to get into investment banking course and giving 50% discounts for people who sign up early. And this, I think, is going to be a super great comprehensive course that goes over behaviorals and technicals and recruiting overview, going over the top banks and what their cultures are like. Like, I just think this is going to be a great one-stop shop if you are interested in banking recruiting, and then bunch of videos that you can refer to here. And then you can also like go to any of my other socials if interested. So that is the kind of situation overview. I also wanted to let you guys know about the sponsor for today's video, which, as you can see from the top right corner, is Wall Street Prep. And they are offering a hedge fund and buy-side investing certificate program going on for this cohort, September to November. And they run this program every 3 months, or sorry, 3 times a year, every 4 months. And so regardless of when you're watching this, basically you can probably sign up. And they do have a $200 application fee that is waived if you sign up by August 12th as of this video. And then this date will change if you're watching it at a different time. And Wharton is where I got my MBA. And so you'll be learning from professors who I didn't learn from these professors in particular, but I did learn from Wharton finance professors, and they are the best for finance. There's also Wall Street Prep directors and then keynote speakers from actual hedge fund investors, including Howard Marks, who I actually met at a Wharton MBA event. He's a legendary investor. Oaktree is one of like just the best distressed investment firms in the world. And in terms of what you'll learn, it's an 8-week course, and you'll go through investment fundamentals, buy-side modeling, which you may be interested in the most if you're watching this, thesis development, and then a lot of like advanced concepts and things like that. Another cool thing is that they're really building this whole entire program out because there's like a private equity certificate program, and then there's this one, and they're making it a global network essentially where you can meet people from across all the different programs. And there's also, in addition to like a LinkedIn only or a invitation only LinkedIn group, there's also networking events. They actually invited me to one a few weeks ago, but I was busy that day. But maybe in New York, I'll be going to one of these events. So I will say a lot of times the people who take these courses are people who are kind of already working in finance and want to sharpen their skills or meet new people, etc. But this course is open to everyone. So with that said, let's look at Chipotle stock. You can see that if you just zoom out, the company has done extremely well over the past, or ever since IPO. And especially and particularly over the past, let's call it 5 years, the stock has really driven up, and only recently has it really corrected. And so that's interesting, right? And Chipotle also recently announced earnings, and we can actually go to see what earnings say. Says earnings blow past expectations, boosted by brand loyalty and value proposition, yet the stock fell because maybe it could be a little bit overvalued. And we're going to go into that for the comps. And I also will be answering questions in the chat here and there. So whenever you guys have any, feel free to ask, and I will get back to you when there's like a natural stopping point. But let's look next at the next item in the agenda, which is trading comps. So I prepared some trading comps for us to take a look at. And I'm going to actually delete some companies, but I thought you guys might want to see this process a little bit. So what I did was look at the top food companies in the world, right? And these are McDonald's, Starbucks, Yum Brands, Restaurant Brands International, etc. But a lot of these companies are really, really small, right? Chipotle's market cap, $68 billion or so, whereas I didn't know El Pollo Loco was so tiny, $359 million for El Pollo Loco. And then you have Jack in the Box, which is $1 billion company. And so you don't want to be comparing companies that are like 70 times as large or even larger, and because it's just not a fair comparison. So what I'm going to do is actually delete everything below 10 billion to kind of make this a little bit more of a fair comparison in a sense. And actually the word I should use, a more relevant comparison. So we can see here in terms of percentage of 52-week highs, looks like Texas Roadhouse. I actually don't even know which stores this company owns. But we can see Chipotle is kind of in the, actually it's pretty much lower than a lot of the rest of the companies here. Revenue growth, actually I feel like these, because I deleted those rows, the formatting probably messed up a little bit based on this. Yeah. Okay, but you can see revenue growth, besides Wingstop, which surprisingly is growing very, very quickly, Chipotle is growing the fastest, except for also restaurant brands, actually. But basically at the top of the pack in terms of revenue growth. And then when it comes to EBITDA margin, it's kind of in the lower-ish half, 20%, 21%, and then profit margin, similar thing. So you can see it's growing the fastest, but not the highest margins. And then on a multiples basis for EBITDA and price to earnings, like PE multiple, you can see that the company is pretty expensive compared to its peers. And so the question is, as we build the DCF, like what do you need to believe to think that there is more room for the stock to run for Chipotle, right? Given these multiples, I'm going to assume that we're going to need to assume a lot of quite aggressively to actually think that there's more room to run. But the stock has been doing well, over the past 5 years. You can also see something I've added here, which is premium or discount to historical multiples. So this is just comparing the current multiples and seeing if it's trading higher or lower than the 1-year overall average, 2-year average, 5-year average. And you can see that Chipotle's multiples are a little bit less than the historical average. And I think these are also need to be adjusted. Yeah, so that's an overview based on comps. So TLDR is good growth, average-ish margins, expensive multiples, so trading expensive. So that's trading comps. And let's now go into the next part, which is the street-based DCF. So we're going to start from scratch, but I am going to pull from a different model for some formatting stuff, just because you guys have, if you follow this channel, probably have seen this a bunch of times. I do try to add a few new things here and there when I can. So like this diluted share count thing is going to be new today. But today I don't want to spend too much time on like formatting and all that stuff. So I'm going to go to one of my previous models, which is the Taiwan Semiconductor one. Let me actually show you guys what I'm doing. So I'm getting, and you can actually download this one if you go into my live section on my channel. Then you can actually download this model and a bunch of other models as well if you just click on it. So what I'm going to do is press Shift and then space button, and then use the hold down Shift and press the down arrow key. And then what I'm going to do is Control Copy. Then go to my Chipotle one, and on here, Alt ESV, Alt EST for formatting. And then I'm just going to, let's see, I'll just delete whatever is relevant to delete. By the way, as I'm doing this, please, can you guys let me know in the chat, how is the mic volume? Because when I was testing it, it was a little bit lower than normal. And so I just wanted to see what you guys thought, or how the volume is. Okay, cool. Seems like volume's fine. Yeah, I'm just going to delete all this stuff, and then that way I don't have to like format everything from scratch. Maybe actually what I'll also do is I can, maybe I can like create this like blank DCF and also add it in as like a file you can download, and then that way you can start from this as well. So I'll add a link to that after the stream ends as well. So you can either start completely from scratch or you can start with all this stuff basically. Okay, so ticker CMG. Today's date 7/27/24 and year end date 31/24. We're gonna add this stuff a little bit later, and we have all the assumptions, or the assumption section here. Income statement. So I have all the historicals, and let's see how far back we want to go. 2014, kind of a lot. But we have the numbers, so why not, I guess. So I'm going to link to my revenue growth, or sorry, revenue, which is just right here. And then copy paste this to 2023. And then 2024, we go to forecast. These are estimates that I pulled in as well. I'm not going to rely on all these numbers, but good to have as reference. So we're going to calculate revenue growth, get our current year minus the previous year, or divided by the previous year minus 1. And then whenever you calculate margins for a bunch of years or whatever, like we just did, it's good to kind of just see what the trend looks like, right? So here you can see 10%, negative 13%. So something happened here, probably like some kind of food scare. Then 15% growth, 9%, and then this big jump probably after COVID. And then now it's kind of this steady low teens growth that the street is estimating here. So we'll keep that in mind as we build everything out. Operating income is just your EBIT. I was just trying to see if there's anything weird going on here. So we can get that to 2023 and then go to forecast and then go to our operating income 2024. I noticed something weird here. 2023 1628, but our estimate for 2023 is 1577, right? So I'm going to jump into, there's a lot of times this is why you can't just take a financial database for face value, because a lot of times something will be wrong. So let's go into the 2023. They're not wrong per se, but they just calculate things differently, actually. That's a better way to say it. Okay, so income from operations 2023, 1.557 billion. This one is saying 1628. So what I'm guessing is that the one we're seeing here is a non-GAAP EBIT, where they're adding back something. So let's see, 1226. So yeah, it's higher here too versus what's reported. I am actually okay with there being or using GAAP EBIT, because that is how the company is reporting. Okay, so I see here, you can see here, there's non-GAAP versus GAAP, right? Numbers are pretty similar. But you can see here for the forecast, the 1577, 1182, 899, these are all, actually they're not tying. 1557 does tie. 1182, 899. They don't tie. So maybe that's GAAP too. Oh, weird. Okay, well, first, what we oh wait. Oh, here are the GAAP. 899. Income from operations 2021. Should be 804 for GAAP, but it's not. Weird. Okay, well, let's see what the numbers look like for now. So we're going to get EBIT divided by our sales. Control R. And then we can see here that overall, the company's margins have been increasing over the past 4 or 5 years or so, and now is just below 20%. Okay, so what I'm struggling with here a little bit is that the numbers are just off a little bit, right? It seems to me that these figures here are some kind of non-GAAP EBIT, meaning that they're adding back something to EBIT. And actually looked at the reconciliation figures for EBITDA in their recent earnings, and it does seem like they add a little bit, right? It's not a lot. Like this 1628 versus the 1557. At the end of the day, that's like what, 50-ish million. Makes a difference, but it's not like crazy. And then this 1898 also seems to be non-GAAP because it doesn't tie here either, but is a little bit closer to GAAP. But you know, I think given that you can't really, so I guess to be as consistent as possible, I'll just kind of like link to, actually, I'll link to these because there are more analysts estimating, and then estimating non-GAAP, I think is just really, really hard because you have to know what is going to happen to a bunch of these non-GAAP items, and there's like just a small number of them. So I'm just gonna take a little bit of a shortcut, not dig into it too much more, and use these numbers. And I'm okay with that. So now let's go to historicals. Taxes are here. And then tax rate is the taxes you pay divided by your taxable income. And you can see here that there was negative taxes for whatever reason that year. So let me actually change the formatting a little bit. Okay. I want to make this percentage thing different. Okay. Yeah, I just like the percentages to be negative, or in parentheses when they're negative. That's a personal thing. Okay, but we can see now we have our tax rates here. And then I'm going to go into cash flow items. Before I do that, I will answer some questions in the chat though. So first, but the chat thing is right here for me. So I'm going to look a little bit to my right and going to the top. Hey, a bit off topic question. What do you think are the best European unis for IB? I actually don't know the European university landscape too well, besides like the top ones like Oxford, London Business School, etc. So sorry, I can't be super helpful there. Do you think business valuation is a good career? The business valuation, I don't really consider that a career because, or I don't know if there's a job like that. But if you want to go, if you're talking about finance or investment banking, etc., then I do think it's a really good career for those interested in the field and who want a really good fundamental background in business, right? Hi from France. You can find the Discord in this video's description. It should be there. 3 financial statement model I will be doing as part of, so I actually recently started building out I did this more advanced LBO tutorial, and in that video, I talk about how in my next videos, I'm going to actually be, so I'm talking about this one right here. I'm going to be building out a three-statement model for the most part in the part 2 and 3 of this, because this is kind of part 1. I actually highly recommend, if you're interested in banking or private equity, to go in to take a look at this video, just because it's the most advanced-ish model that I've built so far compared to all these videos I have on here. So I feel like it's just interesting if like I would have loved to have had it when I was recruiting for banking. Let's see. I see a question about, is it too late to get into GS, etc. at 28-30? If you're coming from an MBA, no, I don't think so. A lot of my friends around that age enter in as an associate after their MBAs. Okay, and I see a bunch of other questions. The DCF template, I just thought about like working off a template instead of like building everything completely from scratch, which I normally do. So I will have the template available for download after this stream and as a link. You can also go to rareliquidcareers.com, and there is, if you go now, there is like a DCF you can download for free in the models tab. So let me show you rareliquidcareers.com. Go to models. You can download, there's like this free advanced one, NVIDIA, this DCF one. Oops, looks like there's something I need to change here too. But yeah, you can download all of these for free, and you can kind of use this one as a template. But in terms of like the one I'm using today, I'll upload that one later. All right, now with that said, let's go into DNA, depreciation and amortization. So I don't want to pull that from actually, can we pull it from here? Usually you want to pull from the cash flow statement. So let me actually just pull from here for now and then see if this is accurate. So 319, go to our 10K and then go to our cash flow statement. Depreciation, amortization, 319, 286, and 254. All right, so these look good to me. And we're going to divide. So we're going to actually use this formula where you press F4 twice on the denominator, and then that way you can copy paste this whenever you need to get your margins. Control R will also just copy everything to the right. Next, CapEx we can get from our cash flow statement. This is forecast, but this should work. Also want to double check this number. So CapEx should be 561, which it is. 479 beforehand, which it is. Okay, so that's perfect. So this is like what you love to see when you are modeling, are just like very, very consistent numbers. This is also partially why I wanted to show you guys Chipotle, because a lot of times the companies I've been forecasting have been very like tech companies that have just growth rates and margins all over the place. But this is like a very, very stable company. And so we should get to a pretty, like this is where a DCF valuation model can be very, very helpful. All right, now changes in net working capital. I actually think I realized I did not pull the cash flow statement, the historical cash flow statement. So I'm going to go to cash flow. While I'm doing this, I see a comment. Shouldn't you understand the drivers of CapEx rather than looking at percentages? Of course. Yeah, that's why this is just a high level DCF model. And yeah, the issue with that not the issue. The challenge with doing what you just said is just getting the relevant information for your assumptions, right? And I could look into it and kind of do all that stuff, but it just takes a lot of time. And this is more for like a high level DCF. Okay. So we have our historicals. And then I'm going to move it to this book or to this CFS historicals. All right. So now we have our changes in working capital here, which we can just link to. And so I also saw a note. Yes, they do have store openings and stuff like that in their filings. So if you want to incorporate it in your model, then go right on ahead. When I look at this 6% and how it's been so steady over time, first of all, Chipotle probably doesn't provide store openings for more than maybe a year out. They're not going to give 5 years out. So you're going to have to make assumptions anyway. So I personally just don't think that it's really worth the time when things look so steady. But you can go ahead after I build this out. You can project that out. All right, change in sales, not needed here. We're going to get our change in cash flow divided by change, in sales. So that minus that. Aren't the store openings the main driver of revenue growth? But we have revenue forecasts, right? So I think you're asking the right questions. Don't get me wrong. It's just that is not what I'm trying to do here. I'm not trying to build like a super detailed DCF because it just would take too long. And I don't know if I could get all the assumptions that I want. I have done this before for like Apple, where I think it was Apple, where I built out a revenue model, like a really small one with like some of the key line items, I think. But when I was doing that, it was like, yes, I built out this more robust model, but then I was also baking in more assumptions that kind of is like more, they say like garbage in, garbage out. And so if I can't rely on the assumptions, back when I was at JPM, for example, like we would just have access to all these different industry reports or equity research reports, and we could actually get pretty good assumptions or a list of them from different equity research analysts and like benchmark them and find the average or the median and use that. But that takes a lot of time, first of all. And then also, I don't have access to that kind of information. So even if I think also Tesla, actually, I remember building out like a really detailed financial model with like a lot of their different cars and revenue streams and all of that. And it ended up being like just a very, very kind of useless model, I would say, because the information was so unreliable in my view. So yeah, sorry, it can't be. Yeah, it'd be great if I could make it more, I don't know, robust, I guess, but gotta make do with what I have. So now what I'm gonna do is just link to historicals here and then start building out our assumptions. And basically we can just copy paste all this stuff and then just move it down. Okay, so now we have our historicals, and what we just need to do now is figure out like how are we going to project out the company's revenue and EBIT margins for the next 5 years. And as I mentioned, compared to other companies, it's not going to be as tricky. I did take a look before the stream to see which estimates we could actually rely on. You can see here that for sales 2026, there's about like 10 brokers or so. And it is also great that it seems like the vast majority of them have updated for the latest earnings report, which was July 25th. But you can see there's around 10 for 2026, but there's like around 20 for 2025. And then similarly for 2024 revenue, right? So this is estimating 2024 revenue. And then these are the different brokers or estimates, or equity research analysts who project out revenue for 2024. And you can see what all their numbers are here. And basically the point of this is if you go to 2026, it's just not comparing apples to apples, right? You have half the brokers not projecting out 2026. And so you can't really rely on 2026. Whereas for 2024 and 2025, I'd say they are pretty reliable because 2024, first of all, we only have like August to December, 5 months left of the year. And then 2025 is only like a year and a half out or so. And so these numbers should be relatively reliable. You can already see here, like, why would revenue growth go from 13% to 14%, right? It probably won't do. It can do that, but it probably won't. So what we're going to do is actually believe 2024 and 2025 for our base case, which is our street case. So we want to be as close to what the street projects as possible. And then we can grow this down. I think what we can do is kind of, let's see how much this, oops. Looks like a 10% decrease kind of. But basically, if you look at the revenue history, it's very up and down, right? Likely what will happen in these next 5 years is that there will be some kind of one-off black swan event or whatever that probably will cause revenue growth to be very lumpy and like kind of grow quickly or like slow down quite a bit. And we just want something that is not going to exactly year by year project out what revenue growth will be because no one can know that, but at least have some kind of range where it kind of accounts for both. And so for me, that probably means this growing down to somewhere around like, well, if we were to grow this down, this is decreased by about 1.42%. Let's see what it would look like if basically we continue the same trend and the decrease is 10% per year. So 28. So we're going to multiply this by our growth rate thing here. I think is a little bit too aggressive. So yeah, this is kind of what I would want to see. Since we want to be a little bit conservative with our street case, because you want to be a little bit conservative with your modeling to provide extra cushion. And we're going to have an optimistic case anyway here. So for 2024, I'm just going to make a simplifying assumption and just assume that we're going to be pretty close to this number. Yeah. I'm just going to assume that we're going to get to this number because we only have 5 months left. The difference is not going to be massive. I'm going to color code it red in order to show that I'm doing something a little bit weird or different here. 2025 and onwards, I'm going to make a little bit less I'm going to make it a little bit more conservative than what we have. And then optimistic scenario, I'm going to make it more optimistic. So let's call it an decrease of like, since we're being a little bit conservative already, so let's just call it 5% for now. And then in the optimistic scenario, I think we want to be a little bit more. So here, we're going to multiply this by 1 plus that decrease. That doesn't look like a huge, maybe make it negative 7.5. Remember that the purpose of all of this is just to have a range to see what you need to believe in order to hypothetically invest in Chipotle. Although, yeah, don't just use this as a reason to invest or not invest. Okay, so I kind of like these numbers because you can see here that while the growth rate has been very lumpy, it in general has been in the double digits. And over time, when as a company gets larger and larger, I can't imagine that the company is going to maintain low teen double digit growth forever. And so in 5 years for them to be around like 8%, 9%, I think makes sense. And let's check this one more time. Maybe let's be a little bit more conservative. Yeah, this is like worst case scenario, base case, and then super optimistic case. Not super, just optimistic case. So now let's build out our switches here. So I'm just going to put them here as 2. You guys probably have seen this before. So what we're going to do is offset, reference the cell we're in, and then go to our switch. That's revenue here. So what this will do is whenever you switch to like 1, 2, or 3, it'll choose from between these 3. And then if we multiply this by 1 plus our revenue growth, then we have a functional model here. One thing I want to add, which I actually did add to the LBO model that I mentioned earlier, was adding this, what was it? Data validation? Yeah. So you can create like this list here and just do 1, 2, 3, something like that. And then that way you can only toggle between these 3. And the reason I do this, or I think I want to do this, is because if you put 4 here, well, I guess first of all you can't, which is what like I'm trying to do. But if I put 4 here, it's going to be grabbing from the 4th row, and so you just never want your, obviously if that happens and someone does that in your model, then that's kind of their fault anyway. But I just want to do that, and I think I'll copy paste this so that it does it for all 3. You can either press the drop down or press Alt down arrow and then down arrow or up arrow to toggle. All right, but revenue we have done, which is pretty sweet that it was pretty easy. And then EBIT we're going to do next. All right, so EBIT I think also is going to be pretty easy just because the margins for the company should just it shouldn't go that much higher than 20% basically from what we're seeing here. And again, similarly, we can trust 2024 and 2025, not so much 2026 and onwards. So we're going to do something similar here again. Copy, paste the formatting, and I'm going to go link to our base case, or our street case here, and then increase this by just a little bit per year. So let's call it a base case scenario. Let's just see what it looks like. If there's a 5% increase or improvement each year. And you can make this like a percentage point. You can make it a, like in terms of, you can increase it by a certain percentage each year. You can linearly grow it. You can do it by multiplying by like a percentage. Kind of up to you, but for me, I wanted to just do it this way. And I think this is okay. It gets pretty close to basically what we see here. And every year for a company, technically your margins should be increasing. I would say maybe like this is a little bit on the, actually it's pretty base case. I want to say it's like overly optimistic or conservative. So for this one, I'm going to also do the same thing with revenue. Decrease it by 5% compared to what we have here. And then for our EBIT, for optimistic case, do the same thing. Well, this is too high. I'm just going to make it a 5% increase. And I just don't really, given the history of the firm, don't really see it changing. Or sorry, don't really see it going that much above this 22%. You can see never has the company gone above 22%, but there is this kind of like, at least based on estimates, positive trend. So we're going to kind of go with it for now. And then see what everything spits out. But I actually do think that given the history, like maybe the company's management now is much better. They figured something out. But I feel like it'd be good to be a little bit more conservative in our conservative case. So I'm going to make this negative 7.5%. Well, then this decreases in 1 year. Don't really like that. Okay. So 17, 18, 19. Then we'll do the same thing here where we have an offset here. I see a great question. Why would margins increase if you have to give merit increases to employees and generally inflation will drive up COGS? Well, they can easily raise their prices, right? So that can maintain their margins. And that's actually, I feel like what they have been doing because Chipotle is getting more and more expensive. So nickels coming from Taco Bell likely was used to serving lower quality ingredients relative to what Chipotle's customers use. Do you think Chipotle's portion size and quality has decreased? No, I feel like portion size, I don't think so. Because I've just been eating it for so long. Like, I just don't really feel like it's decreased that much. Quality, I don't know. I feel like there are good and bad days. Also, I'm realizing this is basically going to, since we have, it's going to be like a 4.5-year DCF, which I think is okay. It has always been trashy. I don't know. I feel like, wait, Taco Bell or Chipotle? Ahmed. He's saying Taco Bell is trashy or Chipotle? By the way, I'm just taking an average of the past 3 years for taxes. Who knows what their actual tax rate will be, but I think this is like pretty fair. I don't want to take this negative 21% because something weird's happening this year. Also, this formatting. Okay. Chipotle. So Med thinks Chipotle has always been trashy. What do you guys think in the chat? Do you guys like Chipotle? I like Chipotle. Well, I will say I used to like Chipotle a lot more than I do now because I feel like I've started to, or I think Chipotle, it has like a lot of sodium. I'm starting to like kind of taste more, but I'm not sure if that's true or not. Like I'm not, I'd have to check, but I think very salty. And I think my diet has been just changing a little bit where I'm not eating as many salty foods. So yeah. Oh shoot. It's almost time to reschedule. One sec. Okay, let me change this. I'm gonna give myself an more time for this. Okay. But let's see what time it is. Okay. Okay, so I see a lot of Chipotle fans in here. All right, so now we have our DNA, CapEx, etc. Wow, this DCF is so easy compared to the other ones because the company is just so like theoretically more predictable given the numbers are not all over the place and stuff. So we can see this trend here, DNA kind of going down over time from like 4% to 3%. So just I guess to stay consistent, what I'll do is do the same thing for our tax rate and for our cash flow items. So we're just going to take the average of the past 3 years. Yes, massive simplification and multiply this times our sales. Anchor that so that we can just copy paste this down a few times. And then we can calculate our cash flow. So our EBOT plus our DNA minus our CapEx minus our change in net working capital. And then what we have to do is figure out our period. So this is where we're going to talk a bit about mid-year convention. So let's see, discount period. What I want to just, or what I need to explain here, and I've explained this a few times, so bear with me if it's repetitive, but essentially, if we were to figure out our WACC and then discount it back now, given or just by one full year, then you're going to take all of the cash flow and then discount it back or project, which is 1 year out, and you're going to discount it all to present value by one full year, right? But first of all, there's two things. One thing is that we don't want to take all of the cash flow because 7 months have already passed in this year, right? It's already the end of July. So first thing we want to do is only take the portion that we're projecting into the future because DCFs are only about the cash you're going to earn in the future. So that's one thing. Second thing is that there's this thing called mid-year convention that bankers do in order to kind of simplify the kind of like assumption or whatever. Well, so basically you're getting cash every day or every like minute as a business, right? So Chipotle every minute is probably earning like, I don't know, a few $100,000. And ideally you want to discount all of that cash flow that you're generating pretty much by like this, by the time you get it and to the present, but you know, that's impossible. So there's a super simplifying assumption that bankers make, which is that, okay, let's just say that you get your cash in the middle of the year. So I'll show you what that looks like. So first of all, we got to calculate how much of the period we have left. So we can do that by getting year frac. And then our current year start date, and then our end year, or sorry, ending date. All right, so this explains to us that we have 0.43 of the year left. And then so the amount of cash we want to actually discount is this much, 440. So that's step number one. Then discount period. So this 0.43 gets us to the end of 2024. And then if we add 1 here, that gets us to the end of 2025. And then 2026, 7, 8. Right? And then now we have to figure out, based on mid-year convention, what is the middle of the year, right? So for this, the middle of the year is just divided by 2, or at least the middle of what we have left in 2024. So this gets us to the middle of between today, July 27th, 2024, to December 31st, 2024. And then now we need to figure out what will get us to June 30th, 2025, June 30th, 2026, and etc. So in order to do that, what we need to do, I remember how to do this, is get this, which is, actually, I don't even think we need this. So we need this, which gets us to the end of 2024, and add half a year, which gets us to the middle of 2025, right? 0.5 years. And then now we're at this state where we need to add 1 because this is June 30th, 2025, June 30th, 2026, etc., etc. So you just want to add by 1 year. These are our periods. I guess we could call this our discount period. And then we need to calculate our WACC. So let's go here. First thing I want to do is calculate our diluted shares. So if you remember, I talked about we're doing the street-based DCF, calculate diluted shares. We're going to need that for our equity value and our WACC. I guess I already did the mid-year convention. Then we're going to do maybe a 1 sensitivity table, talk about price a bit, and then we're done. We're kind of almost there, actually. So shares. So basically, whenever we actually don't need this offer price thing. Or actually, we call this current price. All right. So let's go to FactSet. You can see current share price is $49. Sorry, yeah, $49.83. Make this blue because we're hard coding. I don't like that blue. I'm going to choose this one. Okay. Basic shares. So let's go to the latest filing for the company. And I promise I will go to see a bunch of questions. So I'm going to go talk about respond to questions in chat after I show you guys all this. So as of July 22nd, which is just 5 days ago, there were 1 million shares, right? 1.369 million. I want to actually make this in millions, so I'm going to make it here, make it 1.4. And then what we need to calculate are our diluted shares. That's going to add maybe 1 million more shares or something like that, but it'll get us to a more accurate number. And so what we want to do here is look up our stock-based compensation. And, so normally it's kind of hard to find, but then the 10Q for Chipotle, they just actually list out stock-based compensation in this note. And this is what you're looking for. Sometimes it'll be note 5 or 10 or whatever. It just really depends on the company. And then they talk about their stock-based comp here. So what the heck is SOSAR? Oh, stock only appreciation rights. We grant stock appreciation rights, restricted stock units, and performance stock units. So it seems like SOSAR is just basically stock options, which is what I was looking for. And then you can see that there's 14,000 shares or these options outstanding. Oops. Everything's in millions, so it's going to look like it's 0, but it's actually 100 or 14,000. And then the weighted average price, exercise price is 30.93. Right? So what this is basically doing, my voice cracked. What this is basically doing is if the current price is lower than the exercise price, then these shares are worthless, right? Because basically what you can do with options is buy them at their exercise price and then sell them at your current price. So you can basically just make this profit, essentially, right? $18.90. So everyone would do that in a theoretical scenario where you exercise all these options, then or could, then you would do that, right? Because who doesn't like free money? And then there's restricted stock units, and these are like more special and performance stock units, where these basically there is no exercise price. This is just you get it and then you can sell it. So dilutive impact from other securities. So there's two ways to do this. I actually prefer this way, where 100. Yeah, I prefer this way personally, where you just have the exercise price as 0. And then we can do the same thing here for our performance stock units. And it's very interesting. Chipotle does not have a lot of shares, like options and whatnot. Normally, and also why you see so many tranches is that a lot of times companies break things out. Like you can see here, there is a weighted average exercise share price, right? But let's see if we can find in the 10K more granularity. So I guess they don't have it. Maybe in another future stream. But sometimes they will break down the options to have like all the different exercise prices. So there'll be like a table with the number of shares, so like let's say like 5 tranches of shares and then like 5 different exercise prices. Okay, but so I guess for this model, I'm going to delete this part since we have everything we need here. Net dilutive options. So we have our basic shares. So I'm going to call this 2024 Q to 10Q cover. Always good to add notes for where you got things. And then for these, I'm going to copy paste in the comment. And this was from page 10. So the way to control or copy paste in a comment is control copy, down arrow key, alt ES C. That'll copy the comments. But this I'll have to mention, oops. This is RSUs, PSUs. I think this is page 11. Yeah, it's on the next page. And then these are stock options. Okay. I'm going to add more decimal points here. So we have 1 million shares here ish. These are our exercisable, I'll just call these dilutive securities. I took this from the LBO model, and so it's like a little bit different. Oh, actually, realize I can't do it this way. Sorry. Okay, I'm gonna go back to what we had before. I don't think it's letting me, but basically this is using the treasury stock method, and what it's doing is getting total proceeds. So it's multiplying our exercise price and our dilutive shares. This gets us to the total shares that you can repurchase, and then it calculates the dilutive options. So we're going to need actually a separate tab for other dilutive. Let's just call this like RSUs actually. RSUs and PSUs are like the most common. I'm going to just copy these here. Alt RD will delete the comments. Okay, so this is actually the most accurate. So this you'll need basic shares plus dilutive options plus RSUs plus PSUs. 1.381. So this is just slightly more than the 1.369 million, but it gives us a more accurate number, right? So, okay, I see a bunch of chat here and see a question. Are you proud of your Apple DCF a while back? You had fair value share price of 130. It dipped under the market and is now trading in the 200s. So basically, I get this question a lot of like, oh, your DCF was so wrong, but I'm using the information from what I have at the time, right? So I can only give you, that's like the big struggle with models in general. First of all, they're only accurate. They're hardly ever like truly accurate in terms of projecting stuff out, but then you need to constantly be updating them in order, as you get more information and you have new assumptions, like every day, in order for you to actually accurately be able to make like an investment decision based on your model. So in terms of what we're doing here, like I always say, these are high-level street-based DCFs based on what the street thinks at the time. This is an exercise we used to do at JP Morgan, where we would compare the street-based DCF with what management thinks will happen based on management projections. So more of an exercise, and you can always use this if you want to like change up the assumptions and then maybe make an investment decision if you want on your own. But like I never make investment decisions based off like all these streams that I do. I just invest in ETFs now. I'm safe. So let's see other questions. Bit off topic, but do you have any visibility into how easy it is to make the transition from IB fundraising deal teams to M&A and PE afterwards? IB fundraising? I don't know if you work in IB fundraising, but banks don't need to raise funds because they don't actually invest. So not really sure about that. Can you do the period cell again? Yes, I can. Can you explain the switches offset? Yes. Okay. So period. First thing, there's two things you have to know. So first, you have to, right now here, we're in 2024 to 2028, right? This is what we're projecting. And it's already July. So you don't ever want to get any of your historical cash flow and then use that as part of your DCF, because your DCF is always forward looking. So what you're looking at, what you first want to do is figure out how much time is there left in the year, and that's 0.43 years, right? So if we multiply this by 365, 156 days, divide this by 30 days in a month, we have 5.2 months left of this year in 2024, right? So then that's step number one. And then mid-year convention, and the way we did this is year frac. So this is just a formula, year frac, one date, and then your end date, and this will calculate how much time is left, basically how many years are left. The 0.43 years left. Then the discount period is just a simplifying assumption for mid-year convention. We assume that we get our cash in the middle of that year. So in this first year, we're assuming we get it 0.21 years from now, which is a few months. And then discount period, basically, we're assuming in the future years that we get it in the middle of the year. So that's June. What we're trying to aim for is June 30th, 2025, June 30th, 2026, etc. And so to do that, we 0.43 years from now in 2024 gets us to December 31st, 2024. Then you just need to add half a year. So you're adding 0.5. You get to June 30th, and then you add 1 because that adds 1 more year. So theoretically, so if we have today's date, and then we multiply this by 365, which is the number of years we're adding for this discount period, then this plus this should be June 30th, 2025, right? Which is correct. And I think this will work if I copy paste this. This should be 2020. Oops. So yeah, this is formatting. You can see all these. This is off by a day or so, but you know, that's just probably because of like a leap year or whatever. But you can see that all of these line up. Essentially, that's what we're doing here. Hopefully that makes sense. I need to do all this. Okay. All right. So, I see. I'm not critiquing your Apple DCF. I'm saying people watched that bought Apple below the 130 per share. They've done very well if they held their shares to the current time. Yes, that's true. Why don't you use dark mode in Excel? I didn't even know there was dark mode in Excel, but I'm just used to it being like this. Anyway, okay, now we need to calculate our WACC. So let's go. That's why we calculated. Yeah, so our diluted share count. So to calculate our market cap, now we don't, what I usually did previously was just kind of take this number, but now that we have calculated our fully diluted share count, which FactSet says is 1.381 million, and we have 1.381. Oh, actually, FactSet is very accurate. Wow. I guess we didn't even really need to do that, but whatever. So let's get our current share price, multiply this by our diluted share count. 69 billion. Okay. I feel like it'll be more easy to look at if we actually make it in the millions. Everything is right now. I'm going to multiply this by 1,000. So because everything here is in the millions, everything here is in the millions, and so we just want everything to match. Okay, so risk-free rate, 10-year treasury yield, 4.193. Beta, you can get this on Yahoo Finance as well, but 1.08, so basically does not really change that much compared to the market. Market risk premium, go to this NYU professor who publishes this. Implied equities premium on July 1st, 3.97%. And now let's see if the company has any debt. Thank you. Okay, no debt. That's cool. Makes our lives easier. So I'm just gonna make this all 0, or I'm gonna make tax rate. I guess we can pull from here, but it's irrelevant. I'm just gonna use the number that we're using here. Yeah, so there's no debt. So it's basically our WACC is based on our equity. And we can see here that it's 8.5%, which actually, makes sense for Chipotle. Let's do this same. I'm just going to copy paste this down. Base case, going to use this 8.5%. Our conservative case, make this 0.5% larger. And then our WACC, optimistic case, 0.5%. And then terminal growth rate, 2.5. Conservative, 2%, and then 3%. This is basically around like what the U.S. economy grows each year, and this 2.5% you can kind of use. Yeah, you can use for most of your DCFs. All right, now let's calculate our unlevered present value of unlevered free cash flow. So get that. We are going to use our, actually we realized I should not have, these aren't not switches. So we're going to use the choose function and then go to our switch and then go to our figures here, copy paste this down. And I'm going to name this WACC and then name this one PGR. That way I don't have to go up and refer to them all the time. So we have our cash flow here. We're going to get this and multiply. Remember how to do this. Our cash flow times 1 plus your WACC. So that, wait. No. This is your, oh, oops. What am I doing? So you have your cash flow and then divide by 1 plus your WACC. And then that is to the power of your discount period. Wow, I almost forgot that. Okay, I think I'm doing this right. Divide. It's been a while, I guess. But 1 plus your WACC to the power of the discount period. Yeah, this looks right to me. So I did this differently in these two cells because this first one, we multiply by the amount of year we have left, right? And then divide by 1 plus WACC to the power of the year that we're in. This one, you just need to get the free cash flow, then divide by 1 plus your WACC to the power of the year that you're in. These cash flows look so small. Oh, I did do something wrong. Ah, okay. Because Chipotle is like a $68 billion company, so that made no sense that the cash flows would be that small. And these look more accurate. I'm also going to just double check that I did my calculation correctly because I'm just second guessing myself, but okay, that looks right. Cool. So now we have our present value of unlevered free cash flow. Now we can get our terminal value by getting the last year's free cash flow times 1 plus your terminal growth rate and divide all of this by your WACC minus your terminal growth rate. Wait. No. Yeah. And then, wow, I'm forgetting everything. And then get this and then do 1 plus your WACC to the power of the year, the last year, in order to get discount back to your present value. So again, to go over what I just did. Your terminal value is your last year's free cash flow times 1 plus your terminal growth rate. Divide all of that by your WACC minus your terminal growth rate. That's your terminal value. And then present value of terminal value is your terminal value divided by 1 plus your WACC to the power of your last year, 3.93. Which looks super high. What? Did I do something wrong again? Wait. Oh, actually, I'm not. What is Chipotle's? Yeah, Chipotle's market cap is around 68 billion. Let me see if that's right. I'm definitely doing something wrong. Or my model is just completely wrong. Market cap around 68 billion. This not possible. Is it? Terminal value, last year's free cash flow times 1 plus your terminal growth rate divided by your WACC minus your terminal growth rate. And everything divided by WACC. Yeah, right. Okay, this is really weird. So let's see. Last year's free cash flow times 1 plus your terminal growth rate. All of that divided by WACC minus your terminal growth rate. This divided by 1 plus WACC, the power of the last year. Okay. The reason this is so weird is that this is like basically saying that your company is, or that Chipotle is a like $200 billion company, which it is not. Right, 200 billion. And I don't think I did anything that weird. So plus DNA. Oh, wait, this? No. These all look fine. This gets you to 41 billion. Also a lot. Oh, what am I doing? Okay, I am so stupid. Okay. I actually was doing it right earlier. EBIT minus taxes is your earnings before interest and after taxes. So these numbers were correct. So I like basically am flip-flopping. And now this is super low, which is funny. 31 billion. So essentially, I don't know why I did that earlier. Totally just brain farted, but earnings before interest and after taxes, these are correct. This is what you want. And then unlevered free cash flow is your earnings before interest after taxes plus DNA minus capex minus change in net working capital. And then we're discounting back to present value. And then we're getting our terminal value and then present value, which gets us 31 billion. And we're in our base case. Interesting. Okay. So there's no debt. Cash. Are in thousands. So basically 800 million. Delete this. Okay, 800 million. Okay, so make this green, blue. Equity value is our enterprise value minus cash plus debt. 32 billion. Fully diluted share count we can get from here. That gets us to our implied share price of, oops. This is also weird. Here. 1 million shares. Is in billions. Huh? Oops. I mean, basically, this should be getting us to like $28 or something. Something is weird's happening. All right. Equity value, basic shares. Oh, just need to add 3 zeros. Oh, yeah, because this is, I guess everything's in thousands. Wait, no. These are all in millions. This, why would this need, is there a billion shares? Mm, 1.4 million shares. Oh, what's happening to me? One, 3, 8, 1. I mean, essentially, though, what we need to do is multiply this by 1,000 for some reason. That gets us to our share price, but why is that? This is in 32. Oh. Did Chipotle do a stock split? Post stock split basis June 26, 2024. But why then is it so, why is it not split here is the question. So weird. But this says there were 27 million shares before. The stock split usually means that there's more shares. But this went from 27 million to 1 million. It's like the weirdest thing. You should be seeing, if it's 50, it should be like 100 million shares. Or 80 million or something like that. 70. Oh, everything's been retroactively adjusted to reflect the stock split. So it's weird. So I guess essentially what we have to do. That's so weird that this. Oh, 27. Okay. 27,000? What? 27,000 times 50. So that is correct. What's happening with these shares? Because yeah, I see a lot of stuff in the chat. The reason I'm confused is that the stock had, or Chipotle had 27 million shares, and then they went to 27,000 shares, and then now they're at 1,000,000 shares. It seems like the 1,000,000 shares is correct. Oh, okay. Let's see. So we're at 32 billion, which already is so low, right? But if you have been following along, one reason why I'm not like super surprised is that if you go to, if you remember the comps that we went to, the company is trading extremely high and twice as expensive as its peers. So you can argue like, oh, the growth rate's higher, the margins are actually the margins aren't even that much higher. You could argue like, okay, the company should be trading at half these multiples, which will just cut this stock price in half, which would make it like $25, right? So for us, when we get to 23, 25, I'm like, okay, like that actually kind of makes sense. But these shares, right now, let me just double check my here. These figures are in millions. This, 2023, all of that, these are in millions. So this is $9.8 billion, right? So these are in billions or millions. Everything's in millions here. We're getting to 31 billion, and then equity value of 32 billion by fully diluted share count. This basically implies that we have 1 billion shares, which just does not make sense. Oh, wait. So FactSet does say that there's 1 billion shares. Billion, why? Maybe I'm looking at this wrong. 1369476 shares. All right, I'm not going to worry about it too much. I don't know why it's showing, because even if for the stock split, if you multiply by 50, that's not right? You have to multiply by 1,000. So who knows what's really happening? If you can figure this out later, let me know in the comments. But we're going to multiply this by 60. This number is accurate. This gets us to what we are projecting in the model. I see a question. Spotify won the poll. Why is it not analysis? I talk about this way when I started this stream, but I know Spotify won the poll. but it was by a little bit. And then also, I looked at Spotify's numbers, and the company is super unprofitable. So I kind of wanted to just choose like a more profitable company because otherwise DCF doesn't make as much sense. But maybe yeah, Spotify basically throughout its entire company history has not been profitable until now. It's the latest quarter or so. All right, so let's see what all of this amounts to. So basically in our street-based DCF, we see a 53% downside. If we're super, super optimistic, then we see still 39% downside. And then if we're super conservative, then like a 64% downside. I'm honestly surprised because of all the DCFs that I've done so far. I've not seen one where there's like this huge kind of like discrepancy between the current share price and the implied share price. I don't think I did anything like too crazy or too wrong. If you look here, the revenue growth figures are pretty reasonable. You know, you don't view this as like some kind of like high growth tech company. You don't imagine that it's just going to shoot up to like 30-40% in 1 year, right? Margins of like 17 to 20%, I think are also super reasonable. Tax rate 23% reasonable. DNA and CapEx, you could argue maybe DNA should get a little bit higher over time and converge with your CapEx. Maybe your CapEx is a little bit too high. Like I could see an argument for that. Maybe make this like a little bit higher, but that's not really going to move the needle like that much. I mean, let's call this, let's say we just make this 4%, just for this exercise purposes. And then change net working capital is not going to change that much. So even if we change that DNA to 4%, we're still getting to 24.58 versus 23.25. So I don't know. I don't know how the street is really thinking about Chipotle, but if you look at the comps, you know, again, like the revenue growth rate is not like it's the highest amongst its peers, but it is pretty solid. But margins are not that impressive. There are a lot of other companies that are higher, and they're trading at half of what Chipotle is trading at. So I could definitely, based on what we've done today, see Chipotle moving down further unless it just has an amazing next few quarters financially. But I personally, based on what we've seen today, I don't really like the stock much. But, you know, who knows? Last thing that I wanted to go over that I promised you guys is, I guess I skipped over it, but sensitivity tables and price discussion. So let's just build out a quick sensitivity table. So here, what you need to link to is what you want to get to, which for us is our share price. And then, so this links to this. And then terminal growth rate, you have to like manually enter these numbers in. We're going to add 0.25% on that side. And then our WACC, if you look up here, it's around like 8.5%. So I'm just going to put that. Or actually what might be better is getting this control copy and then here control ESV for value. And then that way you're using what's actually in the model. And so upwards, you want to be getting a lower valuation. So we're going to add here 0.25% again. And then down here, you want to be getting a higher valuation. So minus 0.25%. And that's just because the terminal growth rate's getting higher here. So you want as you go this way, the terminal value to get, or sorry, the valuation to get higher and higher. The next, what you do is you highlight this section here and then go to Alt A V V data valuation. No, that's not right. You go to Alt A V, no, Alt A W. what if analysis, and then you go to data table, which is T. So row input, that's up here, this row, and then column is here. So row, you go to terminal growth rate, which the driver of your, basically what we're doing is we're looking at the drivers of your valuation, and then creating different like scenarios based on all this. So essentially what this is saying is if you have a 3% terminal growth rate and an 7.98% WACC, then you have $27.52 for Chipotle. If you have 2% terminal growth rate and 8.98% WACC, then you have $20.20. In the middle here should be what you have currently in your model, which is 2.5% terminal growth rate and 8.48% WACC, which is what we have right here. So that's the sensitivity table. Chipotle DCF is now done. Let me know if you guys have any questions in the chat. I can answer them. But yeah, this was a surprising one for me because I knew based on the comps that Chipotle was overvalued, but then I didn't think it'd be like by so much from a DCF perspective. So pretty interesting for me, and it'll be intriguing to see what happens in the next few months and years of what happens to Chipotle stock. So yeah, that pretty much wraps things up. I guess there seems to be no comments. So thanks guys for joining. As always, I'll make sure that this is downloadable ASAP as soon as I possibly can. I also created a Discord channel where which you can join, and we'll just like talk about like career stuff, or like if you have questions, feel free to join there. And I also announce like my streams now on here as well. So like here I talk about like, hey, I'm streaming tomorrow, blah, blah, blah. Anyway, thanks guys for joining, and that wraps things up. So I'll catch you guys in the next one. Thanks guys. Peace out.